Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include some MBA Annual previews, my interview with Geoff Sharp at Eris Innovations, the creators of CME's Eris SOFR swap futures, on the growing need for SOFR-based cash flow hedging solutions, and we will finally receive CPI among other economic releases this week. Just what does that mean? Stay tuned. Today's podcast is brought to you by nCino, makers of the nCino Mortgage Suite for the modern mortgage lender. nCino Mortgage Suite's three core products, nCino Mortgage, nCino Incentive Compensation, and nCino Mortgage Analytics, unite the people, systems, and stages of the mortgage process into a seamless end-to-end solution embedded with data-driven insights and intelligent automation. See how nCino can support a homeownership journey that your borrowers and your team will love at nCino.com. Why did the Dalai Lama go to Vegas? Because he loves to bet. Here at the MBA Annual, the puns may not be flying, but there is news bouncing off the walls. Some of it learned just by chatting in the hallways. And there is plenty of time spent walking through the convention center, to which some are saying they need a segue. The Mortgage Bankers Association announced that total single-family mortgage origination volume is expected to increase to $2.2 trillion in 2026, from $2 trillion expected this year. Purchase originations are forecast to increase 7.7% to $1.46 trillion next year, and refinance originations are expected to increase 9.2% to $737 billion. But just know that hope springs eternal among economists, especially when they work for an organization who's incentivized to tell you that things are going to get better. Just my 2 cents. By loan count, total mortgage origination volume is expected to increase 7.6% to 5.8 million loans in 2026 from 5.4 million loans expected in 2025. Since the boom, that's 2020 and 2021 years, lenders not only laid off tens of thousands, but the successful ones have been implementing technology, operational efficiency, and management improvement. Are you ready for a pickup? Here's some chatter from the hallways. Credit Bureau TransUnion, that's one of the three owners of VantageScore, along with Experian and Equifax, has followed its peers in cutting prices for mortgage lenders that purchase VantageScore 4.0, responding to FICO's latest pricing move. In Freddie Mac and Fannie Mae news, government officials continue to assure the MBA that any move away from conservatorship should and will minimize any increase to mortgage rates. Freddie, for its part, is making progress on the VantageScore and FICO Classic rollout. And call it FHFA or U.S. Federal Housing, one group is asking the public for feedback on its proposed strategic plan for fiscal years 2026 to 30. To which one person quipped, "We don't know what's happening 5 days from now, and they're looking out 5 years from now?" The new plan proposes 3 strategic goals for the agency: responsibly overseeing Fannie Mae and Freddie Mac, supervising the federal home loan bank system, and efficiently managing U.S. federal housing operations. Input on that plan is due by November 5th, 2025. For today's interview, I wanted to welcome to the show Geoff Sharp of Eris Innovations, the creators of CME's Eris SOFR swap futures tool, on the growing need for SOFR-based cash flow hedging solutions. He's managing director and head of product, joining Eris in 2015, and has nearly 3 decades of global capital markets experience. He's been managing director of interest rate sales at Nomura Securities International, and previously held senior-level derivative sales and trading roles at Lehman Brothers in Tokyo and New York.
Start with kind of a high-level overview of what's going on in the secondary markets or capital markets space. When it comes to non-agency mortgages, we've seen that certainly proliferate in terms of volume, in terms of interest, in terms of investor demand, those sorts of things. When it comes to hedging out there, what's going on in the non-agency space from a hedging perspective?
Yeah, so that's an interesting question because for the last 15 years, the market's been dominated by agency production. And agency markets have this unique TBA, which allows you to deliver the mortgage into the mortgage security in a very elegant manner. And it happens on a monthly basis, regular cadence, very efficient. Non-agency market, on the other hand, has no such TBA. And that has essentially driven a lot of the originators into simply originating product on a best efforts basis. To be fair, there has been obviously some hedging in the jumbo space where people use treasuries. We'll get to why I believe that this should be SOFR, but more importantly, there isn't a TBA market for the non-agency space. So originators and people carrying risk do the best they can. And majority of that is give it to somebody else and let them deal with it. And I'll take a best efforts price, certainly at the originator level. At the securitization level, which is obviously a growing marketplace today, well, let's take a step back. The non-agency market has evolved in the last 8 years at the same time that LIBOR was being abandoned. And that essentially created a problem for the non-agency space because in order to hedge interest rates, one needed an interest rate instrument. Historically, that was LIBOR and Treasury futures, where LIBOR was the ubiquitous instrument used by everyone to hedge interest rates. It's correlated interest rate risk. But with LIBOR going away, a lot of the market essentially said, well, let's just use Treasury. SOFR hadn't developed. And because there was no swap market, we were forced into using Treasuries, which frankly are relatively inefficient because Treasuries have their own balance sheet idiosyncrasies. So here you have a mortgage product, mortgage rates that you're hedging with a Treasury, and a Treasury has balance sheet and capital use idiosyncrasies, creating a basis risk that's not highly correlated. What you really need is a pure interest rate like LIBOR, that it's not around anymore. You need a pure interest rate upon which to place your interest rate hedges. You're obviously left with spread risk between mortgage rates and pure interest rates, but at least that's a clean basis upon which you can now manage. And if you're in the moving business, like a lot of these mortgage originators and securitization shops, you're only really concerned with, 45 to 60, maybe 90 days of interest rate risk at most. So what I see developing, and it is happening at sort of the professional end of the spectrum, is a migration from the non-agency space being hedged with treasuries for a short interim to being hedged with much more granular key rates in the SOFR space. And what I mean by key rates is, you underwrite a mortgage and it has a prepayment schedule. That prepayment schedule can be essentially replicated. Your hedges in the key rates offset the mortgage rate that you're underwriting.
I have to ask a rudimentary question for some of my listeners. Why is there no TBA market in the non-agency space? Why can't people hedge non-agency instruments well?
Great question. So the TBA market's core strength is the centralization with the three agencies, Fannie, Freddie, Ginnie, and the government guarantee that those agencies provide for those mortgages, create an incredibly large marketplace and sort of consistency. And of course, this is 30, 40 years old. For the past 15 years, the Fed and US banks have been flush with cash, and the Fed have been buying mortgages. And they were constrained to buying government guaranteed paper. So they needed to buy agency wrapped paper. That fueled demand in the agency mortgage space. Of course, low rates certainly helped and so forth. Fast forward to today, banks are choking. Their portfolios are full of underwater agency securities. The Fed's no longer buying, and the G fee is pretty expensive. This opens the market up to private investors, and private investors are looking at the marketplace and sort of saying, well, listen, I don't need to pay for the G fee because I don't need to buy agency government guaranteed paper. So give me non-agency paper. The point being is that the non-agency doesn't have a government guarantee or a framework around it. So what you have is this disparate market of private label securities issued by one securitization agent or one bank or one originator. You've got over a dozen, if not 24 originators of RMBS, private label RMBS, whereas you only have 3 issuers of agency wrap paper. And on top of it, you have this neat little government guarantee. So creating a very liquid, core, standardized non-agency residential mortgage-backed security market, and therefore this over-the-counter futures market, or TBAs for non-agency space, is not trivial, and I just don't think it will happen. It didn't happen back in 2000s when there was $1 trillion of non-agency. In 2007, there was almost $1 trillion of non-agency mortgages originated. And there was no sort of non-agency TBA back then. There were indices that people referenced. And I think that we're going to start seeing indices that people reference, but they're not securities.
We're seeing a lot of demand in non-agency products, whether that's jumbos. Non-QM has had a huge surge to the forefront. DSCR is becoming more and more popular. There's RTL, the ARMs has always been the historical conundrum. How do you hedge ARMs? And it's been kind of an insider joke that you don't among capital markets folks. But these loans aren't TBA deliverable, so TBAs aren't the right hedge. What is currently going on with these loans when it comes to securitizing that? What do you predict as being the future? How are you? That's kind of my lead into talking about Eris a little bit.
Yeah.
But what do you see as the inefficiencies that can be solved here?
Well, all of these instruments, okay, are based upon primary mortgage rate in those markets. Okay? And the primary mortgage rate in those markets cannot be traded because there's no TBA. And in reality, TBAs are secondary rates anyway. But as there's no tradable instrument in these markets, you then sort of take a step back and sort of say, okay, what is the cleanest, most efficient way to predict these rates? Now, the principal component is the path of interest rates. And the path of interest rates is most efficiently traded using SOFR. On top of it, there are complexities with supply and demand, credit quality, and so forth. And you're starting to see the vendors, okay? Now, bear in mind, the vendors of Citus and Optimal Blue and MIAC have spent 15, 20 years very, very focused on the agency space. But you're starting to see those vendors take their cash flow models that they've been using to manage the MSR side of the equation and apply them to managing the cash flows of these non-agency mortgages and say, wait a minute, these non-agency mortgages have key rates. We should hedge those key rates. We know we can't hedge the mortgage spread, but we never could. We can use proxies perhaps and sort of budget a little bit with high coupon TBA or low coupon TBA. But the problem is that liquidity of those instruments is not very good. And that illiquidity means the hedges are frankly inefficient in the short term. They may be valuable in the long term, but they're inefficient in the short term.
I was going to say the goal of any seasoned or established capital markets shop or operation is to move from best efforts to mandatory in a lot of senses. And so the easy route here has been selling loans to investors on a best efforts basis. Will we see a shift to mandatory here in the future? Does SOFR allow for that? Is that kind of where you're going with all this?
Yeah, it does. And we're seeing a tremendous amount of appetite here. So, from the small shop doing 25 million of non-agency, non-QM or DSCR on a monthly basis, where we're having entry-level discussions, to shops that are, well north of 100 to shops that are, 500 million a month. Up and down this profile stack, there is appetite to improve execution. And one way to do that, obviously, is to bulk up and sell. Selling onesie twosies or best efforts, you're essentially passing the risk on to someone else. And by the way, you're passing it on to someone who's using SOFR to hedge it. Okay, so that's what we're seeing. We're seeing sort of a downstreaming of hedging practices from the big professional aggregators to the smaller originators. I don't have definitive data. This is early, but there are what I do know is that there are various different levels of sophistication, where some people are very granular and they're hedging it with a combination of 2-year, 3-year, 4-year, 5-year, 7-year, and 10-year rates in SOFR, and some who are just hedging it with a combination of 3, 5, and 7-year rates. But in all of these cases, they're coming back for more, and they're doing more and more and more. So I got to imagine there's decent pay up associated with this business. It doesn't mean they don't continue to do some element of best efforts, but my guess is that they're selectively holding on to choice pieces because they know they can get a good price with someone closing out a securitization.
Yes.
Or an investor looking for that type of collateral.
And obviously granularity is the goal here. As the capital markets move into the future, transparency, efficiency, granularity, speed of transaction, those are all very important things. I want to talk SOFR quickly before we get to Eris. And people are probably relatively familiar with the LIBOR scandal that made for the ultimate sunset. And SOFR, the secure overnight financing rate, has taken its place. You talk about what SOFR is on a basic level, and then what makes it such an important, valuable instrument when it comes to being able to move into the future with all the technological capabilities we have in this day and age.
Yeah, sure. So the beauty of an interest rate swap, and it's key to understand this to start with, is that it is an off-balance sheet transaction. It doesn't require you paying money to put on a hedge. Now, you do have security and, call it transaction costs. But the action of trading a swap does not require to use balance sheet. You don't pay money up front for it. But for a swap to be effective, it needs an unmanipulable, fair index rate. Because a swap is essentially saying, I'll pay you a long-term rate on a fixed basis, and you pay me the index rate as the index resets. So a swap needs an index rate. And the swap market became too valuable, too important. The regulators saw that LIBOR was ineffective, manipulable. They needed to change it. And they came up with this rate called the secured overnight financing rate. For good or bad, better or worse, it is what it is. But it is based upon over $2 trillion worth of overnight collateralized financing transactions. So what's that? That's overnight repo. That's me giving a government collateral. So I give you Treasury securities, you lend me cash. Tomorrow you give me back Treasury securities, I give you back the cash. Overnight repo. And there's over $2 trillion of these transactions taking place daily. And what the Fed do is they collect all this data from the main players in the space, and they throw out the highs and the lows, and they average it, and they come up with this rate called the secured overnight financing rate. And it tells you the average of these overnight lending transactions. And it tells you this, unfortunately, but it is what it is, the day of settlement. In other words, we transact today, from today to tomorrow. The Fed will tell us the average of all of these transactions from today to tomorrow. They'll tell us that rate tomorrow morning. So the SOFR rate tells you what the rate was. And you are sort of relying on this index rate being real, because it was based upon, over $2 trillion worth of real transactions taking place every day. It's not manipulable, although the Fed can manipulate it to a degree, but that's their job. Okay? So now you have this index rate, and this index rate is very, very powerful because it now can be used in the swap market to develop a complete yield curve of swaps. And there is a full-term structure of interest rate swaps from short-term, call it 1 month, all the way out to 50 years, right? Doesn't really trade much beyond 30, but there are rates being quoted out there. What that means is that you could be an entity that has a constant line of credit based upon overnight rates. And all funding now is based upon this overnight rate. One shape or form, SOFR plus this spread, SOFR plus that spread, but it's all SOFR. So if you now want to convert that floating rate funding into a fixed rate, you can go to the swap market and you can say, I would like you to pay my SOFR rate. I will pay you a fixed rate. What's the market for that fixed rate? And there is a very liquid term structure, at least out to 30 years, where you can say, all right, I'll pay you a fixed rate for 5 years at 3.2%. You pay me compound overnight SOFR. And by the way, this transaction, we enter at zero cost. Yes, we both pay some small marginal initial margin of 1% up front just to secure the transaction and secure that we will each make our payments, right? But now we have a swap, and this is very powerful because this swap can now be used to efficiently build very, very robust models to predict future rates, okay? And when you can predict future rates, you can now manage the prepayment risk in the mortgage because the mortgage will prepay, amongst other things, on the level of rates. Now, you do have to make some assumptions as to what the spread between SOFR is and the primary mortgage rate, which will drive the prepayment of that mortgage. But the point is, this hedge is zero cost, bar transaction costs. You're not using huge amounts of balance sheet to do this. This is a transaction because that's the nature of the swap.
And I was going to add that the practice will get better and better over time as people continue to
No question
hone in their methods. Let's talk Eris here for the last part of this interview. You are working on, there's CME's Eris SOFR swap futures. What is that? Why do you believe so strongly in it? Bring some awareness to what you're working on, please.
Yeah. So the swap market is incredibly important, to reiterate what I've said already, because it provides this framework upon which you can build very, very robust and accurate valuation models, but now you can actually hedge with those swaps. And if you can hedge with the swap that's used in the valuation model, you limit your slippage from a risk management standpoint. Let's call that unexplained. You limit the unexplained in the behavior of your portfolio. Rates moved, your assets move, you have your hedges on, they offset those asset moves. So the swap market, being incredibly valuable for this purpose, has become incredibly expensive to use and sort of documentation heavy. It's sort of the privileged few at the very top of the food chain can access the swap market. So what we set out to do was to essentially democratize this. We've created a product that's available to absolutely everybody. You want to trade 100,000 notional, guess what? The price is the same as when you're going to trade 100 million notional. It's counterparty agnostic. It's centrally cleared. So it's leveled the playing field. There's no more hierarchy. Market makers also cross the gamut from swap dealers to private trading firms. And today in Eris, the amount of liquidity being provided in Eris is probably split, 50-50 between banks and non-banks. In the swap market, it's all banks. Okay? There's a hierarchy associated with the price you get when you go to a bank for a swap price. What Eris has done is essentially made what is otherwise a high-level institutional product, almost quasi-retail, right? I'm not selling it to mom and pop. I'm selling it to small non-bank mortgage companies because it's incredibly valuable. And let me tell you, there is nowhere in history where financial firms have grown without some form of hedging. And there's also plenty of history of rising stars flaming out because they didn't have hedges. Eris is fundamental to that, and it makes hedging accessible to anyone.
Let me close by asking you, for people looking to trade swap spreads with futures, best next steps. What are how can they get a hold of you? How can they get more information?
Well, a couple of things. This is a CME Group product. We created it. We licensed it to the CME Group. Anyone who's traded futures before, and a lot of the non-banks, particularly the big institutional non-bank space, is familiar with trading futures. This is just another futures product. Trades alongside Treasury futures at the CME. For those new to the world of financial hedging, then it's important to appreciate that in addition to the vendor that you have for risk management of your agency pipeline, you probably want to be working with a vendor that can tell you a little bit more about the risks in your non-agency pipeline. Where are the key rates, right? How much sensitivity to those interest rates do I have? Because I'm going to use SOFR to hedge that. And then to access SOFR as a futures contract, you need a brokerage account. Similar to a 401k account for trading stocks or an IRA to trade stocks, you need a futures account at, a CME member firm to trade CME futures. And that could be a Wall Street bank, but it could equally be a non-bank, like an R.J. O'Brien StoneX or an Archer Daniels ADM, or a Wedbush Securities or Macquarie Bank, who are not mainstream Wall Street banks. The key here is you need a futures account. Now, futures account need not be complicated. You can open one within 48 hours. More realistically, it's probably a week. You don't necessarily need to fund them to open them. And they're very, very cheap to operate compared to central clearing of over-the-counter swaps. And remember, being futures, you can try this out in 100,000 notional size. before you scale it up to the size of your hedge. But it's important to have a futures account and have a risk advisor. And at Eris, we can certainly help connect the dots. We're not a vendor. We're simply a product creator and IP licensing firm. But we work very closely with a number of futures firms, helping them onboard or certainly connect the dots with new customers. That's really, it may sound complicated. Once you roll up your sleeves, you start to see the light, and it's fairly simple.
And I would add, erisfutures.com, ERIS futures.com is a good place to go. Geoffrey, I really appreciate the time, man. I wish you the best of luck. I think it's some really cool things you're tackling here, and it's helping the industry in aggregate. So thank you very much.
Pleasure talking to you, Robbie.
The backlog of unreleased economic data continues to grow as the federal government shutdown approaches week 3. In addition to September's delayed reports, the shutdown is likely to affect data collection for October, potentially impacting both the completeness of the data and the timing of its release. As for data that was released last week, the NAHB Housing Market Index improved in October as lower mortgage rates boosted builder sentiment. However, the index remains well below the 2015 to 2019 average as builders remain fairly pessimistic about current market conditions. Last week also featured speeches from a number of Fed officials, most notably Chair Powell, who indicated the Fed's quantitative easing cycle may be coming to an end. Powell and Fed Governor Christopher Waller both reaffirmed their concerns regarding labor market conditions and indicated further monetary policy easing could be appropriate at upcoming meetings. The markets are pricing in 25 basis point rate cuts following each of the 2 remaining FOMC meetings in 2025. However, given the backlog of economic data that might be received prior to the December meeting, if there were to be a pivot from the committee, it would likely occur at that time. Turning to economic data, the U.S. Bureau of Labor Statistics will release Consumer Price Index, that's CPI, figures for September on Friday for Social Security benefit purposes. But it will also provide information to the Fed ahead of its October 28th and 29th monetary policy meeting. The agency has been minimally staffed due to the government shutdown. Investors will also be keeping a close eye on trade developments between the U.S. and China, as the world's 2 largest economies spar over the Asian nation's strict rare earth export controls. This week gets off to a quiet start with just some short-duration Treasury auctions today. Economic releases over the remainder of the week include Philly Fed Services for October, the Chicago Fed National Activity Index for September, existing home sales for September, Kansas City Fed Manufacturing, S&P Global Markets PMI flashes for October, and final October consumer sentiment. We began MBA Annual Week with agency MBS prices unchanged from Friday's close, the 2-year yielding 3.47 and the 10-year yielding 4.01 after closing last week at 4.01%. Let's wrap up with a joke and some housekeeping. Do Las Vegas churches accept gambling chips? This may come as a surprise to those of you not living in Las Vegas, but there are more Catholic churches than casinos. Not surprisingly, some worshippers at Sunday services will give casino chips rather than cash when the basket is passed. Since they get chips from many different casinos, the churches have devised a method to collect the offerings. The churches send all their collected chips to a near Franciscan monastery for sorting, and then the chips are taken to the casinos of origin and cashed in. This is done by the chip monks. Thanks again to nCino for sponsoring this week's podcast. nCino's Net Mortgage Suite for the modern mortgage lender includes 3 core products: nCino Mortgage, nCino Incentive Compensation, and nCino Mortgage Analytics, uniting the people, systems, and stages of the mortgage process into a seamless end-to-end solution embedded with data-driven insights and intelligent automation. To learn more, visit nCino.com.